Porsche shares took a wrong turn Friday and tumbled 7%. It was the biggest drop among European firms and marked its worst day since listing on the stock market. Porsche shocked investors with a statement late Thursday it expected a profit margin of just 10 to 12% this year. That was well below analyst expectations and under its midterm target. One analyst called the margin forecast a major concern. They added investors will expect further explanation from management ahead of full-year results in March. The luxury automaker said it will take an $832 million hit to profits as it launches new combustion engine and plug-in hybrid models. Porsche was valued higher than its parent company Volkswagen when it made its stock market debut 3 years ago. But it's struggled to live up to that since then as EV sales have struggled to get going and it's endured weak Chinese demand. Shares slumped just over a quarter last year. The company said last week it was in talks to end the contracts of its chief financial officer and sales chief early. That after both were criticised for Porsche's poor performance and weak share price. Online fast fashion retailer Shein is reportedly set to cut its valuation in a potential London listing to around $50 billion. That's according to 3 people with knowledge of the matter. It would be nearly a quarter less than the company's 2023 fundraising value of $66 billion. Shein's business prospects have come under a cloud in recent days after the Trump administration said it would close the de minimis duty exemption in the US. The import rule had helped Shein keep prices low by allowing small value packages of less than $800 to be shipped duty-free. Fast-growing online retailers like Temu and Shein have built big businesses shipping products from China at rock-bottom prices, often using the de minimis rule. Analysts say its removal could hurt Shein's profitability and push up product prices in the US, its biggest market. Shein did not respond to a request for comment. The removal of the rule is part of Trump's imposition of an additional 10% tariff on China. Nearly half of all packages shipped under de minimis come from China, according to a congressional committee report. Shein was reportedly aiming to go public in London in the first half of this year, assuming it secured approvals from regulators in the UK as well as in China.
Wall Street's main indexes ended mixed on Thursday as investors digested a slew of earnings and scrutinized big tech companies' cloud growth and AI investments. The Dow lost almost 0.3%. The S&P 500 gained more than 0.33%, and the Nasdaq rose over 0.5%. Shares of Amazon, which closed higher, fell in extended trading. Although the tech giant's quarterly revenue results beat market expectations, revenue from Amazon's cloud unit fell short of estimates. Jason Betts is private wealth advisor at Redwood Wealth Advisors Ameriprise Financial.
As we have progressed here into 2025, and the market looks at valuations, my feeling is that the market has possibly grown a little bit less tolerant of anything but really good blowout earnings. Now, having said that, we've had some misses today, and we have a market that has been pretty measured and not really panic sold at all on that. Overall guidance for 2025 has been a little bit unenamored as well.
Shares of Pinterest, up slightly at the close, soared as much as 22% in extended trading. The image-sharing platform forecast first-quarter revenue above market estimates thanks to its AI-powered advertising tools. Shares of Skyworks Solutions plunged nearly 25% after the Apple supplier forecast revenue declines in its mobile segment and projected current quarter profits below estimates. And shares of Philip Morris jumped nearly 11% after the cigarette maker posted better than expected quarterly results and forecast 2025 profit above estimates. Investors now turn their attention to Friday's non-farm payrolls report for January to gauge the state of the labor market and the Federal Reserve's next moves on interest rates.